Hello, chart watchers, and welcome to this Tuesday, May 22nd Market Watchers live show with your hosts, Tom Bowley and Julius DeKempenaar. Aaron Swinland will be back with us tomorrow. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, let's get started in the action today. So far, we got the Dow Jones Industrial Average down 21 points. The S&P 500 actually up 4 today, making this breakout above the high we saw a little over a week ago. The NASDAQ continued to consolidate in a flag formation, up 8.5 points today. The Russell 2000 continues just to make its way higher, although just 1 point so far today. 10-year Treasury yields continues to hover right around that 3.07 mark, but that is much higher than we saw at the last high when we never got above the 3.03 level a few years back. So we do remain in breakout mode on the 10-year Treasury yield. The volatility index continues to drift lower, down another 1.6%. We are below 13, down to 12.87. Financials beginning to play catch up with those rising interest rates. You can see the XLF leading today, making a breakout. Look at the banks taking off. Beautiful flag formation, a breakout, potential breakout there. The life insurance group, we've talked about that recently. We're going to talk a little bit more about banks and life insurance companies in just a few minutes. But you can see life insurance also making a break to the upside. Transports did confirm their breakout yesterday above 10,800, seeing a little bit of profit taking in the group today, but that was a very significant breakout by the transports. Biotech's watching closely. A move through 1975 would be bullish. We are up nicely today with still a little bit more to go before we get to that 1975 level. And on the flip side, the worst performer in the S&P 500, AutoZone, they reported earnings. Look at this gap up. We went from about 665 or so up to 700 at the open, traded as high as about 710. And look at the reversal here on AZO. It's one of the reasons why I try to stay away from stocks that report earnings. Looked really good at the open, but shortly afterwards, we saw a lot of selling in AZO, and it has not performed well since that open. And with that, let me bring in my co-host, Julius. How are you doing today, Julius?
Hi, Tom. I'm fine. I hope you recovered from your birthday yesterday.
Well, I tell you what, it was a great birthday. I am recovered. And, the one thing I didn't want was for my Washington Capitals. I don't know how closely you follow hockey here in the U.S., but we got the Stanley Cup playoffs going. The Caps, I don't need to say, they just normally don't perform very well when it gets in the playoff time. But they were facing elimination last night. They had to win. I didn't want them to lose and go out on my birthday. And fortunately, they did win. They won 3-0 against Tampa Bay Lightning, and they're going to force a Game 7 for tomorrow.
Wow.
So going to be exciting.
You know that I'm actually a field hockey umpire. So it's not ice hockey, but field hockey, what we play here in Europe.
Oh.
And I'm an umpire there. Although it's my last year.
What do they think of umpires there? Because I know sometimes they don't get they aren't treated particularly nicely here in the U.S. I'm just wondering if it's any different.
No, it's the same everywhere. It's just how you handle it, I guess. I don't know.
There you go.
Still fun.
Yeah, absolutely. Sports are fun. And so is the market. We're going to get into it right now. We do have a busy schedule coming up, so let's go through it. We got David Keller joining us tomorrow. That'll be a return visit there. Of course, on Friday, everything StockCharts. We'll give you some more tips about the website, how to use the website. And then just want to remind everybody, on Monday, it is Memorial Day, so markets are closed. We will not be here, but I want to wish everyone a happy Memorial Day, and thank you to all the veterans out there for your service. And today's agenda, let's jump right in. We've got RRG 101. That's our workshop for today. So if you're unfamiliar with RRG, you're going to learn a lot more here over the next 30 minutes or so as Julius walks you through the relative rotation graphs. Technical scans. This is going to be a little bit of a follow-up with what Julius was working on yesterday, showing you how he uses the scan engine and then uses RRG. I think it'll fit right in after that RRG 101. So looking forward to that. 10 in 10 will be coming up at 10 till 1 Eastern time anyway. Fifth Third Bancorp will be our first stock, FITB. And then like yesterday, the rest of the stocks will be picked by Julius as he goes through and puts them into an RRG just to see which ones look interesting. We'll pull those charts up for you.
I'll pick them out of the chat box just to make sure. You punch a number of tickers in the chat box. I'll run them through an RRG, and I'll come up with my picks from that group that you provide me with.
Absolutely. So just feel free, type in your ticker symbols, stocks that you want to have looked at. You actually get them looked at kind of twice, once by Julius going through the RRG, and then the ones that make the cut. We'll pull the charts up and take a look at those. And then we're going to finish today with what would you do? The symbol is going to be DJP, and there's a poll. So I want you all to kind of take a look at that. But it's the iPath Bloomberg Commodity Index Total Return ETN. Of course, we've had the dollar breaking out. Kind of surprisingly, commodities going along with it to the upside, breaking out. So interesting, maybe interesting ETN to take a look at today and get your thoughts, as well as Julius's mine, on that on the commodities and that DJP. What would we do with that? So definitely participate in that poll, and we'll go over that later in the show when we get to that segment. So with that, let me go ahead and switch over. We're going to pull up the 10-year Treasury yield. Always like to start there. Go through a little technical news, and then in about 10 minutes or so, I'll bring Julius in, and he can go through the RRG 101. You can see right now, let me just make sure we got a quick update here. So I got the latest. It's not really doing a whole lot. Yeah, still sitting at 3.07, but the overall uptrend remains. There was no economic news out this morning, nothing of significance. So again, the bond market just kind of flat, not really doing a whole lot, but still within the this longer term, or at least intermediate term, uptrend that we have been seeing, as you can see here on the chart. So interest rates do continue to move higher, even though they have paused recently. And that leads me to a couple of charts that I want to show you. So let me pull those up for you.
Hi, Tom. You know what I just realized?
What's that?
You're doing this segment right now.
Yes.
And then I'm going to be on from 12:15 to straight into 10 and 10. So I need to be transferred into a woman so I can do two things at the same time.
Oh, there you
go. Talk
go.
and get my 10 and 10. So I work really hard on the 10 and 10s now. So you do your thing, and I hope I'll be ready before you finish this segment.
All right, we'll try and figure it out. We'll figure out something.
Yeah, no worries.
Well, it'll be best, I guess, if you get your ticker symbols in early then, while I go through this, so that Julius can be filling those into an RRG chart. That would be very helpful.
Good, right now.
Good point. Thanks for bringing that up. I did want to bring up I wanted to take a look at the 10-year Treasury yield. And, you know, we like to pull up correlation. We like to look at different areas of the market. And I got a lot of this work from John Murphy. You know, I can't say enough about John's work over the years in terms of comparing different areas of the market and trying to put all the puzzle pieces together and looking for opportunities, trading opportunities using some of this data. So with the 10-year Treasury yield moving up, one of the things that I realized over the years is that typically what we see is a pretty strong correlation between the direction of the 10-year Treasury yield and the direction of financials relative to the S&P 500. So in other words, when yields are rising, financials tend to outperform. When yields are falling, financials tend to underperform. And the correlation down here at the bottom of this chart kind of summarizes that, if you will. If you're not familiar with correlation, you can compare any two asset classes, any two stocks, whatever you want to compare. You just simply put up at the top, or well, down here on the bottom, correlation. You put in whatever it is you want to compare. So in this case, I've got the XLF colon $SPX. That's telling me how financials are doing relative to the S&P. And then I separate with a comma the 10-year Treasury yield. So I can look at these two. And anytime you have a correlation reading above 0, it means that the two tend to move together. If you have something that comes in at 1 all the way across or very close to 1, it tells you really they go hand in hand. But here you can see it's not always hand in hand, but it is generally positive, meaning that the two do tend to trend in the same direction. Now, if you look back over the last 9 years, 10 years, really throughout this bull market, you'll see that for the most part, this relationship is a positive correlation. We do tend to see the financials outperform when yields are rising and underperform when yields are falling. And that's what these readings above 0 tell us. But check out these recent readings. Well, 3 of the readings, the most recent one just coming in now. But over the last 8-9 years, we've had 3 pretty significant negative correlations. In other words, they start moving opposite one another. But notice the last two times they quickly corrected. And here we are again with this negative correlation. So what's causing a negative correlation? Well, the 10-year Treasury yield's rising, but on a relative basis, financials have been underperforming the last few months. So one of two things is likely to happen. Either yields are going to come back down and probably fall for quite a while, or we're going to see financials outperforming. Now, today, financials are leading, and I believe we're going to see that latter scenario where financials outperform the S&P 500. So we've got this negative correlation. Maybe we go a little bit lower, but history tells us that if we hit minus 0.5, we're probably getting to a point where it's really time for something to come back together here between these two classes. So we've got to continue to monitor this, but I believe it's going to be financials moving back to the upside and outperforming the S&P 500. And if that's the case, we definitely want to keep our eye on banks and life insurance companies, because both of these areas of the financials tend to do really well when the market is moving to the upside. So here I pulled up the life insurance versus the S&P 500, which has been going down. And here you can see clearly that the 10-year Treasury yield has been going up. And if we go down to the bottom here, look at the negative correlation. We talked about this, Aaron and Julius and I think last Thursday. And you can see that this negative correlation is just starting, it looks like, to correct. But we got down close to a -1, which we had never seen over the past 9 years, really throughout this bull market. We had not seen this kind of negative correlation. And so it tells us one of two things. Either the yields are going to come falling back down, or we should begin to see life insurance outperform. And since we talked about this just a week or so ago, we have begun to see life insurance outperform. And I think it's worth noting because if rates continue to move higher, life insurance companies and banks tend to do very well. Their profit margins tend to move higher when you've got a rising interest rate environment. And you can see after breaking down here earlier in May and taking out these prior lows, we came right back up, got right back through price resistance, went right through the 20-day. Now we're trying to go through the 50-day. And not that this has any impact based on Treasury yields, but the truckers from a technical perspective just did the same thing recently. Early May, you see this breakdown below the prior lows, and then we just started coming right back up. I'm not so sure we're not going to see the same thing here with the life insurance as we make our move back to the upside. Overhead resistance probably going to come in at about 830. You can see the gap down that we had back in March, went right back up, filled that gap, couldn't get through. So I think we're going to see a little bit of resistance 830 and then maybe a little bit more at 840. If it gets through 840, though, I think we're going to have a pretty strong move in life insurance stocks to the upside. So that's something to at least be aware of and be watching for. The other one that I wanted to bring up, and I'll just go ahead and adjust it here. This way you can see how I have this set up. Let's just do the bank index relative to the S&P as well. So now we've got the 10-year Treasury yield up here, and we've got banks versus the S&P 500. And you can see that the Treasury yield has broken out. Banks have not relative to the S&P 500. And again, there's your negative correlation. Anytime we've fallen back below zero, we have quickly come back in line. So again, it's coming down to, are rates going to drop, or are we going to see outperformance by the banks? Good question, but I favor the latter. I think banks are going to outperform, and I think life insurance will outperform. A couple of breakouts I wanted to just go over real quick. I happened to notice today, thought I'd bring these up before we move on to Julius's presentation. ASB, this is Associated Bank Corp, so it is in that banking space. You can see multiple tests up around 27.25. We got the breakout yesterday above this level. Now it's trading up near 28. I think ASB looks very good, solid. AZN, this is in the pharma area, but AZN made a breakout above that April high. Very solid volume yesterday to confirm the breakout, and it is continuing to move higher. WCN, this is in the waste and disposal services area. Here you got a breakout, potential breakout. Now I want to see this confirm on the close. volume could use a little bit of a boost as well. If we fail and close below 76 today, my guess is we're going to go back down, test that 20-day one more time, possibly price support at 74. But I think if you get the stock back down to 74s, it would probably be a pretty good entry. We do have a nice sideways consolidation before we had the breakout in early May, pulled back, and now we're trying to break out again. WCN looks pretty solid technically as well. The last one I wanted to mention is AREX, and this is Approach Resources. And notice after really moving lower for a few months, we kept sideways consolidating, couldn't really get through 290, and look at the volume picking up the last 2 days. So for those of you like small stocks, the volume coming in here, big breakout. I do think overhead resistance comes in first at about 330, but if we can clear 330, I think it's got a shot to make a run up near $4. And with that, I'm going to turn it over to Julius. I know he's got a bunch to go over, but give us some RRG 101, Julius.
Hey, Tom. Yeah. Okay, I'm multitasking here right now, but I'll make that work. Okay. For those of you who have never seen an RRG before, these are the charts. You can get them basically anywhere, but let me size this. I need to get the screen. Come on, share my screen. Yes, here you go. Okay, this should be it. Okay, I hope you can see my screen now. And what you're looking at is an RRG of the 10 S&P 500 sector ETFs. Basically, this is showing you the relative movement of all sectors inside the S&P 500 in one screen. And there is immediately the biggest advantage of using RRGs because it gives you the big picture in one picture. To make very, very sure, this is all based on relative strength. So it is very well possible that sectors or stocks move into the leading quadrant. Why they are there, I'll get to that a little bit later on, while they are going down. So be aware of the fact that this looks at relative performance against, in this case, the S&P 500. So here, XLE Energy is now the outperforming sector inside the S&P 500. It's beating the S&P 500, but it would also beat the S&P 500 if the S&P 500 was going down and the energy sector was going down, but the energy sector was going down less fast than the S&P 500. That's the relative performance that we're looking at. To get you up to speed, we need to go over the basics, and the basics is relative strength. So here I have my chart list, which has all S&P sector ETFs listed. And one thing that I want to point out to you is the behavior of the relative strength line. All these charts in this list have the relative strength line, just as Tom just showed you when he was doing his comparisons with treasuries and banks, etc. And what you see below it are the two RRG lines. It's the RS ratio and the RS momentum line. The RS ratio is a measure that calculates trends in a universe and compares them to a benchmark and puts them all on the same footing. And that's very important because all these values across the universes are comparable. And that's the big, big difference with the raw relative strength line. I call this a raw relative strength line. That's straightforward XLB divided by SPY. Now, I looked at two examples that I wanted to share with you, and that's XLV and XLK. Look at XLK. That's technology. It's a very strong sector. Look at that trend in relative strength. That's still going up very, very nicely. Now note this reading here. That's 0.254. Now, if we scroll to XLV here, that is healthcare, and you see that the relative trend here is clearly down, but the numerical value is 0.3. So it's higher than for XLK, but the trend is going down. So this means that I cannot use that numerical value that comes out of that ratio chart. So I need to rely on my visual inspection of that ratio chart to make up my mind. I could do that. That is possible. I can browse through a number of those charts, and you just saw Tom, pulling up a couple of different relative strength charts together with the correlation. But he had to flip from chart to chart and every time create that new relative line. And that's one of the problems that you have with relative strength, is that the numbers are not comparable. And if you have, in this case, for example, 10 gig sectors, or if you go to level 2, 24 gig sectors, you would have to look at 10 by 10 is 100 charts, because there's 10 sectors, so you've got 10 by 10 combinations makes 100. Now, clearly, if I've looked at I cannot look at financials against financials, because that's 1. So the number of elements in the universe, in this case 10, I can subtract from 100. Leaves me with 90 possible choices. However, when I've looked at, let's say, financials against technology, I've already seen technology against financials, because it's the reverse. So that 90 combinations, and I can divide by 2, but it still leaves me with 45 possible combinations. And I'd have to flip through 45 of those relative strength charts to figure out what it is, because I can look at financials against SPY, and I can look at all the individual sectors against SPY. But if I need to make up my mind what's the best one, I need to compare them all against each other and not only against SPY, because I can say, healthcare is doing well, financials is doing well, and technology is doing well, but which one of those 3 is doing the best, or which one do I want to look at? And then I have to start comparing these 3 against each other, which leads to the 45 charts. If you go one level deeper to the industry groups, it gets even worse, because you've got 24 industry groups, and that brings me to 276 possible combinations. Now that's, even if you want to do the work and flip through all these charts, it'll be very hard in your head to put that all together and create a big picture in your head. And that's how the RRG lines and the RRG chart can help you. This is a basic canvas of a scatter plot, or the basis for an RRG. And on the horizontal axis, we've got the RS ratio. That's the red line that you just saw in those charts. And on the vertical axis, we've got the JDK RS momentum line. That's the green line that you saw on those charts. If we plot every sector in this case on this plot based on those RRG values, we will find the sectors that are above 100 on the RS ratio and above 100 on the momentum line in the top right hand leading quadrant. This means that the trend is up, because what the RS ratio line, the red line, is above 100, and that trend is still being pushed higher by strong momentum, because the momentum line is still above 100. Now, the first thing that will happen is that momentum will start to level off. Momentum is a leading indicator. Rate of change, basically, is a leading indicator. So what we're looking at is the rate of change of that trend. And if that starts to deteriorate, it pushes that sector into the weakening quadrant. In that case, the red RS ratio line is still above 100, so the trend is still up, but the momentum is leveling off and going down, so it's losing momentum. If that loss of momentum continues and it pushes the red line below 100, then on the RRG, we will move into the lagging quadrant. And this is a situation where we have a sector that is in a relative downtrend, and that downtrend is still being pushed lower by weak momentum. Again, after a while, momentum will be the first thing to change, and in this case, it's going to change upward. and it will move above 100. And in that case, the sector will go into the improving quadrant, which means that the green momentum line is above 100, while the red ratio line is still below it. And if that rotation, if that strength continues, then the sector will rotate back into the leading quadrant, and we're back at where we started. And this pattern happens all the time, and it happens to rotate in a clockwise fashion. And that's what you will see on an RRG. Now, let's make that on an RRG. I had another, this one. Because this was the RRG as I had it, because there's a bit of a story here. You can probably watch it back on some old webinar, how I got to this, how the idea was born. But this was the first one that I looked at, and it showed you the little dots at a specific point in time. And you can see here on StockCharts, you can see here that it's the week of May 22. We're looking at a weekly RRG, by the way. It helps you already to show you that XLE right now is very strong and XLP is very weak. But we're technicians. We like to see some sort of historical movement. And that's where the tail comes in. And the tail you can set here. You can add historical data points to that chart. And here you got like 3 weeks. And now you can see the movement of those sectors. And the longer you make that tail, the better you can see that clockwise rotation. Now, obviously, when you do it like this, and luckily enough, this one has only 10 ticker symbols on it, but you can already see that it's becoming a little bit of a spaghetti. But the guys at StockCharts have done an amazing job, but because they have added an animation button. And if we max it here and we animate it, you can actually see the sector scroll through time. And here is where the value is, because this picture gives you the movement, the relative movement of all those sectors through time. Not only the 4 weeks that the tail shows you, but you can also either drag the sectors or you can press the animate button. I'd advise you, or encourage you, I should say, to play with the buttons and the controls that you have here. The zoom button zooms in, and you can then drag and see more clearly where things are. And if you want to have a bigger picture, you can zoom out and make it, wherever you want it. If you max it, it means that all the symbols and all the tails will be on the screen during the rotation that is loaded. If I fit it, it will fit it on a specific date. If I scroll it right now, some things will scroll off the chart, but you will still see them. You will still see that there is one somewhere down here, and I can drag it up and it will be there. So fitting fits it at a specific date. Maxing will maximize it, keep everything on the plot for the whole period. And if you center it, it will always keep the center of the chart in the middle. And while you scroll through time, now please watch the scale on the axis. The scale on the axis will be adjusted to keep everything on the plot. This is a pre-populated group. We have a number of pre-populated groups here. If you look at it, you got major market index, you got US industry index. This is probably the one that is most used. Sector ETFs, that's the one that we're looking at right now. But last week ago, I have added a breakdown for all the individual stocks of those sectors. So if you want to look at, let's say, the staple sector, you just click on XLP and it will be loaded with up to 50 stocks, and they're weighted on their market capitalization. So if there are more than 50 stocks in a sector, this group will hold the top 50 based on market capitalization, and it will be compared, in this case, against the XLB sector index. Again, you can play around with it and you can pick your stocks and do your stuff. One of the things that I really like to do is select one of the lines in the table below. By the way, the percentage change that you will see is based on the number of weeks. So this percentage change is the percentage change of this particular stock over the last 5 weeks. If I change that to, let's say, 8 weeks, you will see that the percentage change changes. And if I do it 1, this is the week to date change. Let's put it back to, I think I had like 4, maybe, I don't know. But what happens if you select the line in the table, it will highlight the tail on the chart, which still gives you the big picture because, you know, they're all still visible, but this one is highlighted. Now, if you press Control and then press the down arrow key on your keyboard, you can walk through all these individual stocks and, you know, make up your mind and, you know, say, hey, Coca-Cola, that's pretty nice. By the way, that was my pick yesterday in the Monday setups. And somebody in the chat box, I remember, said, boy, why are you picking Coca-Cola? Because it's a weak sector. He's right. You know, XLP is the weakest sector in the universe. The reason why I picked Coca-Cola is because it came out of a scan that I will talk about later. But you can see here that Coca-Cola is outperforming XLP, and it's actually looking pretty cool against the S&P 500 as well. So that was the reason why I picked Coca-Cola. So you can browse through and make up your mind. We're 4 minutes before this segment ends, and I got into trouble yesterday again. I'm gonna use your input because this is the RRG that holds all the ticker symbols, as far as I could grab them from the chat box, on the 10 and 10. So let's just do what I just showed you and highlight the first one, and I'll very quickly talk you through why I think something is interesting and maybe something is less interesting. Now here, NOG, a very strong stock, undoubtedly, but it is in a massive relative uptrend against the S&P for a long time already, and it's losing relative momentum. So I am pretty sure that this is a very strong stock, but it's losing relative momentum and it's had a big run. So it's probably very late to get in. So I'm going to skip this one for 10 and 10 because I do think it's too much risk right now. This one is interesting, RRC. By the way, I switched to daily RRG. So it's daily observations. We were looking at a weekly RRG earlier on. We're now looking at a daily. There is a big article in the Chart School pointing out the differences between daily and weekly RRGs, but it's basically the same difference as between a weekly and a daily bar chart. That's the short version of explaining it to you. So RRC is something that I'd like to look at. COPX looks nice. Yeah, it's close to the benchmark, but you see that it made a nice rotation and it's now pushing into leading. So I'd like to take a look at that one. Disney, very close to the benchmark, improving. If I'm not coming up to 9 stocks, then maybe. FCX in improving, gaining on both axes. That's interesting. I'd like to see that one. This one is already losing it, so probably not. Not really nice. It's doing nothing. Very short. Short tails are kind of, you know, directionless. They're not very interesting. They're stable, but in this case, they're stable on the left-hand side. CZZ could be an interesting one. Make a little note of that one, and then I'll narrow it down later on. IBM, same. Could be interesting. Tail is not too long yet. All these little observations, all these little white dots are daily observations. So it's they're still close together, but it is improving. So that's good. Amgen looks nice. That's about to cross over. So Amgen is definitely something that you might want to look at. Where's my list here? Amgen. Yeah, there you are. This one is not yet. It's coming out of leading into weakening. It's losing momentum. Could be a very strong stock, but not for the time being, not for a trade, not for a 10 and 10 trade. Same for QRVO, same for RH. This one could be interesting because it's picking up momentum already and it could turn back into leading without going through lagging. So I'm going to ask Tom to have a look at this one. Maybe that's giving us some potential. Where is my list? Here it is, HBR. This one dropping out of leading, not yet for the time being. No, not Netflix, not for the time being. FITB, I know it's Tom's first choice. I'm not very excited about it from an RRG point of view. It is on the right-hand side. It's a short tail, but let's see what he has to say about it. Voya could be an interesting one. We've looked at this. I think we looked at it last week when we did the RRG segment on Thursday, and Voya was one of the stocks that we liked. So it seems to have picked up. That's nice. So let's have another look at Voya. So where am I now? 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, we're already 10. Let's see if there is anything. Could be a gutsy one. Walmart. It's turning up. CMCM, CVNA. I would do CMCM and CVNA are potential interesting ones as well. This one, no. This one, no. And now we have done. So how many have I noted? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Oh, damn. Got one too many. Let's quickly switch to the weeklies. Let's see if we can get any more information from that chart. So CVNA, yeah, like it because it's still there. On the daily, it was a good one. HPR, yes, certainly. RH. That one. That one did not come out on the daily, but it looks very good on the weekly. So I'd have probably, we don't have time to go into that, but I'd definitely look at that chart. Kai, no, it's one that you might want to look at if you're a longer term investor. It didn't come up on my dailies. OCs, no. RRC is the one that I picked up on the daily, and it's moving in the right direction on the weekly, so that's cool. This one, rolling over, not like Netflix, no, too strong. Very strong trends, probably gonna curl around, but it's too early right now. I would pick this, I would look at Netflix when it starts to go higher on the momentum axis as well, while still in weakening. That's when I start to become interested again in Netflix. NOG looks interesting. Didn't pull it up on the daily, but on the weekly, it's definitely one that I would have a look at. AAP, now Voya, nice one. It's still here. It's turning up. It's turning up on the daily. So yes, we're going to look at that. CZZ, no. FITB, same position as on the daily. So potentially interesting. Curavio, no. Cool. What's happening here? So this is where you, for example, what you want to do here is zoom in and see what's happening there. Got it there. It's probably, yeah, look at that. It's making this very sharp turn. Coming in there, turning back up. And that's the one that we liked on the daily as well. So that's good. That's good news. PRGS, no. Walmart. CMCM turning back up. That was one that was on the daily, kind of maybe. So maybe that one. Disney, not enough power behind that. I don't like the fact that the tail is so short. If it starts to lengthen the distances, then it becomes interesting. Right now, it's just a very stable performer, a little bit underperforming the S&P. IBM, not very good on the weekly. It came up nicely on the dailies, but I don't like it on the weekly. Scratch IBM. Amgen. Same, not too good on the, looks good on the daily. Maybe it turns around. So here we are. Okay, Tom, I am going to go into my scan and I am going to give you the symbols. You right with me?
I'm ready.
Okay, here you go. So FITB, that was your pick.
Yep.
And then number 2 is COPX.
Okay.
Number 3 is RRC. Number 4 is HBR.
Okay.
Number 5 is Amgen, AMGN.
Yep.
Number 6 is Voya.
Okay.
Number 7 is FCX.
Okay.
Number 8 is CZZ.
Got it.
Number 9 is CVNA.
Okay.
And number 10 is CMCM. I would normally spend a little bit more time on this list, but here you go. This is it. Let's see what happens.
All right, I got a question for you.
Yeah, go ahead.
Because first of all, that was great to be able to go through and watch you as you kind of went through each one of those symbols and kind of see what you liked on the daily and then also on the weekly. Because just I think the RRG is very similar to just looking at a price chart. I mean, it's always good to kind of back up, see the big picture. It was like I think it might have been Disney or IBM, one of those on the daily chart. You were kind of interested, but then when you looked at the weekly chart, you said, it really doesn't look very good. So that big picture bothers you. Now, if you were going to tell everybody out there, like what if you were looking at a weekly and a daily chart, what would be what's nirvana for you?
Nirvana would be, so we're at the weekly here. Now, let's just pick two, So, for example, Netflix and NOG. So NFLX and NOG are inside weakening, but they're on the right-hand side. So on the right-hand side of the chart are all pretty much relative uptrends. If they are in weakening, this is in an uptrend, but going through some sort of a correction. They're losing momentum. Now, just think about a relative strength line. That's not a straight line. It goes, it makes higher highs and higher lows. So when it moves from a higher high to a higher low, it's still going down a little bit. It's losing momentum. That's what you see on the RRG when it drops down. Now, clearly, if the rotational pattern continues, that's the end. But what we see in very strong trends is that a stock drops into weakening and then curls back up and comes into leading again. And that's where you make your higher low and go to push to your higher high. So Nirvana, the stuff that I really, really like is when you're in weakening, but curling back up. And Nirvana probably would be when this happens on the weekly and the daily at the same time. Okay. So, we can quickly do that because there are such nice little tricks. If I duplicate this one here, I get the weekly, and we're looking at NFLX and we're looking at NOG. So now we have an RRG just for these two stocks. Let's center it. So we have it there, and then I do another duplication and I center it. And this one is my daily. I update. So now I've got my daily and my weekly. I thought everybody knew this, but apparently people didn't know how to do this. But this is really cool on a Windows machine where you can put these two. Where's the other one? Here, next to each other. So now I have this is my weekly, and the right-hand side is my daily. So I got NOG coming up on the weekly. So the long term, it's sort of inside the sweet spot. It's losing a little bit on the daily, but mind you that this goes 5 times as fast. This rotation goes 5 times as fast as this one. So every observation here is 5 here. So 1, 2, 3, 4, 5. This curve here, this tail here, is the equivalent of this here, because this is just 2 days, and this is last week. So 1, 2, 3. So it's probably this piece that we're looking at. If this rotates very fast, it can pull NOG back into leading, and I would be very interested. So right now, I'd be watching NOG to drop further, and when it curls around and comes back up, that's when I'm very, very interested. What also could happen is that it curls back up here without going to weakening. It's not very likely, but it could happen, and that's when I'm getting interested. For Netflix, this is the weekly, came here. On the daily, we had the rotation on the right-hand side. Oh, whoops. So it's moving its way here, but if that can turn around, maybe a very short period here, but when it keeps closing, starts to move into the top right-hand corner at what we call a positive heading, Netflix very, very interesting because it will definitely pull Netflix back up to leading again inside that weakening quadrant.
Okay, I know you want to get into the scans.
Yeah, I should.
Yeah,
otherwise we're late again.
Yeah, I just want to say, though, that with Netflix, it is like consolidating right at a major level up in the 330s. So in addition to what you're doing with the RRG, you also, I'm assuming, would look at a chart. And if we're getting a breakout,
hang out. Whenever you do this, the next step is to bring it into your own workflow. So, you bring up the charts that you like to look at with your indicators. If you like Aaron's work with Decision Point, you bring up, DPO dashboards, you look at the PMO stuff. If you like Tom's work, you bring up Tom's charts. Doesn't matter. I mean, RRG will give you the big picture. It'll give you some ideas where to look at. If you're a long short trader, you can pick up some long ideas inside the improving quadrant and short ideas in the weakening quadrant, and then you put them against each other any way you like it. If you're an Elliott wave analyst, you start doing your counts. If you're a trend follower, I don't care. But RRG is just giving you the big picture. I'm not calling any shots or signals from an RRG. Always do the work on a real chart.
Okay, perfect.
All right. For those of you who were in the show yesterday, I started doing a little bit of scan exercises, which I started doing for myself. And the basic reason is because I like to do that many years ago when I just started out in TA and I didn't have RRG yet. I'd like to do some swing trading and some shorter term, pick up a couple of trades every month. And I ran across a book which was written by Larry Connors and Linda Reschke, which is Street Smarts. And there are many good strategies in there, but the one that I really like is Turtle Soup. I explained yesterday where the name come from, so you can watch back that show. What it basically does, it looks at failed breakouts. That's what it's looking for failed breakouts around the 20-day low. Very quickly, the rules for the setup. It's a setup. It's not a trading system. It's a setup. It gives you an entry point, and you can take it into your own workflow and make your stops and your take profits and your money management as aggressive or as conservative as you like. So what we're looking for is a market that makes a new 20-day low. The lower, the better. The previous 20-day low must have occurred at least 4 trading sessions earlier. Yesterday was someone in the chat box saying, so we're talking about trading days, not calendar days. Yes, we're looking at trading sessions. So it's trading days, not calendar days. 4 trading sessions earlier. So we'll have a situation where a market comes down, makes a 20-day low, bounces up at least 4 days, and then makes a new low. That's when we become interesting. When during the day the market drops below that prior 20-day low, we're going to place a buy stop 5 to 10 ticks above the previous 20-day low. That's our entry point. And that's good for the day only. If your stop is filled, then we place a good till canceled sell stop 1 tick under today's low. So it's a very aggressive stop because we're assuming that this breakout is going to fail. So we're going to bounce the other way. So if it's a valid breakout and it goes the right way, we want to get out as soon as possible because we don't want to be in front of a freight train. So when the position becomes profitable, you can use a trailing stop or any type of stop strategy that you want to do to protect your gains. Your re-entry rule, that's only on day 1 or 2. If you're stopped out on day 1 or 2, you can re-enter on a buy stop at the original entry level. On a chart, it looks like this, and I'll go to the zoom right away. This is where the market makes a new 20-day low. Then it bounces up 1, 2, 3, 4 days, and then on day 5, very briefly, we drop below that 20-day low, and during the day, we reverse back above it. So that's where we get in. A couple of ticks above 210.39. Let's say 211 or 211.5, whatever. And then you got a nice run up, a couple of days that it moves up. Wherever your trailing stop is, whether you use it here, you could ride all the way up. Probably swing traders would look to get out around 290, 220. But that's the type of trade that we're looking at. So why am I interested in these types of trades because RRG is trend following. And this is looking for reversal. This is trend ending. And my thought is that if I can find trend ending characteristics and I can look at where they are on the RRG, then I might be able to pick them up at a very early stage. So what my ideal situation probably would be, but we'll see if we get any of those, is when my list of possible securities plotted on an RRG starts to curl up either inside lagging or even better inside weakening. So if I have a turtle soup buy setup while on the RRG my trail is starting to curl up while in the weakening quadrant, that'll be very, very cool. What I'm looking for is the S&P 500, so that is group equals 500. What I'm looking for is a new low for the day. That's this code, low equals the min of 20 days. And that's the last condition that we're scanning for. And then we look for the prior 20-day low. And that is a situation where the 4-day low is the 20-day low. And then 1 day ago, 2 days ago, 3 days ago, so that's the days before the 4th day ago, are bigger than the 20-day low. So these 3 days lows are higher than the low 4 days ago. And all these are ands. If that is fulfilled, then I'm interested. The problem is, and this is a thing with the scan engine, there's not really a loop while or a for then loop in the code. So what you need to do, you need to create your own loop basically. And the other thing that you want to look at is 5 days ago, because it can be 5 days ago. And then the 1, 2, 3, 4 days must be higher than the 5-day low, etc., etc., etc. At the end of your scan, and I'll give you the code in a minute, you can run it on end of day data. And what you are then looking for is a market, because you don't know whether the market has dropped below its 20-day low. So you're looking for markets that made a 20-day low close to today. And then what I did is I look for n% within that 20-day low. So you can fill in that n% to find a number of candidates. Obviously, the higher n, the more candidates you will find. If the market is open and you want to look for actual candidates that have dropped below it, you just comment out this rule here and you put in this one, which looks for the actual low and see if it is the 20-day low. Now, let me quickly, because again, we're running out of time, my God. We're going to look at the scan engine, scan workbench, and I have created this one here. Let's bring it to you. It's a quite a long. Well, I'll plot it in a blog, or we'll make sure that you can get it somewhere. Here is what we're doing. We're looking for that 20-day low, and you see the double brackets because we want to include the fact that it is in the S&P 500. Here we're looking for the 4-day low. And then you see the double bracket, and this is an or, because it's or the 4-day, or the 5th day, or, so it's within the double bracket, it's and. All these have to be fulfilled. And then at the end, it is or, because it can be or the 4-day, or the 5th day, or the 6th day. Any of those is fine. And you'll see that my list of days gets longer. So the 6th day, 1, 2, 3, 4, 5. 7th day, 1, 2, 3, 4, 6. So I did this all the way down. So this is basically, in for those of you who have done a little bit of coding, this would be a loop. In the scan syntax, I've solved that problem doing it like this, making it or and just basically manually creating my loop all the way down to 17 days. And we have minimum of 3 days. So we're looking at roughly 20 days back. And here you will see, this is the line that you can use for end of day data. Now we're looking at if something is within, in this case, 3% of the 20-day low, but it didn't make a new low yet, but it gives you a good idea of something that is pushing against that 20-day low. And if the market is open, you can scan for this one here, which is looking for the actual low. Now let's run this. I'm eating your time, Tom, on your 10 and 10. You have to forgive me. You stole my thunder yesterday.
Yeah, you're fine.
Okay, so this scan, I just ran this scan on the last intraday update. So we're looking at real-time data, but we're looking at something that is within 3% of its 20-day low. Is that right? Yeah, 3% of its 20-day low. That gives me this list. That's 32 stocks. That's not too bad. That's not too bad. So then you can, and I'm going to replace an existing chart list. I'm going to replace this one here with these stocks. So now I have my list here, and I can actually throw them at an RRG. Nice, plenty of names. Shorten the tail a little bit because we're looking at some short-term opportunities. And then we're going to look at where we see opportunities. Well, this is live because I have not prepared this at all. I have no clue what I'm looking at. And then I will bring this up in my chart list. So my chart list is this one here. And what I will do is I will create, this is a chart style that I created where I can very nicely see the lows, and I'm going to apply this style to all the tickers in the list. So we can very quickly look at them, and I'm going to do the same. I'm going to put this one on one side, and I'm going to put the RRG on the other side. And now we can, where's my chart here? Now we can play around nicely. Here you go. So let's see. Oh, that's not the right RRG. Sorry, guys. This one. HSIC. Where is that? HSIC. Well, here's a 20-day low. That's not a trade for me. It looks nice, but not great. MON. That's, you know that, Tom. Did that have some news, some takeover news or something like that?
I'm not sure. Maybe earnings. When is it? April?
Could be. Yeah, it's a pretty good chart. You know, but it's not failing at that list, you know, so it's very close to that. It's within 3%, but it's not what we're looking for. HRL, probably not. We need something that is curling. This one could be GXO. CXO. All right, this could be interesting. It needs a little bit. It needs to drop below 148, 148.12 to trigger a signal. But I like this, and you know, if it holds above this support area, then it could be interesting. So I'd be watching this to potentially pick it up around 148 if that signal is triggered. By the way, I'm using this scan to find stocks that are close to their 20-day low, potentially creating this turtle soup buy setup. But what I've learned is that it's a very good way to give me access to stocks that are trading very close to their 20-day low and turning around because they're potentially fulfilling turtle soup setups. When I combine it with RRGs, I can find powerful setups. This I don't like from an RRG point of view, so I'm not going to look at it. Nearing at this one, KMI. That's better. So we didn't quite make it to that low. It's still possible because we're in the 20-day period, but you can see higher highs, higher lows. This 1575 looks to be a nice support level. This could actually be a nice inverted head and shoulders pattern. So if not, dropping to this support level, if it breaks above 1875, I'd definitely be interested in this one, combined with that strong RRG. This is not good. This is not good. Johnson & Johnson. Have a quick look. This is close to support. I don't like the fact that it's lower high. So there's still selling pressure, but it could be like a spring type of situation where, if we drop, and we're looking here at 121.28, if we drop during the day below 121.28, and we get back above it, let's say to 121, maybe 121.50, then that would be very interesting buying opportunity, especially because it's very slowly improving on the RRG. It's improving. That could be a nice catalyst. So that's one that I have on my list to watch. ES. One thing that'll look anything good. We'll look at it quickly, but could be. It needs a little bit more relative strength, but from a trading point of view, little triangle that's broken, didn't fulfill the requirements for the setup, but it could be an interesting stock. Let's see if we can find a real nice one, and then you can do your stuff, Tom.
No problem.
PHF. What's that? Ooh, that's better. That's pretty close. It's 47, 46, 76. You probably can't read it on the screen, but it's 46.76. So if we, this is the 20-day low. Be careful. This is not a 20-day low. So we're looking at 46.20, 46.21. If we drop below it, get back above it within the next, I think this will be there at least for 5 more days. Anything below 46.20, getting back up above 46.25, 46.30, that's a nice buy signal. And it's improving. It's picking up a lot of momentum on the relative strength line. So this one is definitely interesting. Walmart. Hey, there was one on the, I didn't like it on the RRG. That's, somebody asked for that on the 10 and 10. I'll give it, this is a freebie. All right, here you go. This is a very nice support level around this area. Just this little drip here. So 81.49, anything below 81.49 and coming back up in the next few days, that'll be a potential buy signal. It could be a very big base forming. And you can pick it up at low levels with a very short stop. It can be very aggressive. That's it. Sorry about it, Tom. You go ahead and do your 10 and 10, and I'll have. I'm around until the end, so if there is anything that comes up, I'm going to watch in the chat box. If there's any questions, and maybe we have some time, I'll try to address them.
Yeah, I think that should work well. No, not a problem at all, Julius. And you haven't really been on the show that often, and when you do come on, you really spend a lot of time on the RRGs and not so much time on the scanning and how you use the site and all. So I thought this was a really interesting segment. I didn't want to, I wanted to make sure you were able to get through and really explain in detail how you do a lot of this, when you're looking at potential trades or investments and so forth. So I thought this was awesome. Very
Cool.
well done. Everyone can see the summary slide there on Julius' technical scan, the stocks that he went through and took a look at. Great job, Julius. Excellent.
Yeah, and I'll make sure that the actual scan code that I'm using gets published somewhere, either in the RRG blog or somewhere else. But it'll be there for you.
All right, we are going to zoom through the 10 and 10 and the market update and so forth. So let me go ahead and just jump right in. FITB, Fifth Third Bank Corp. I like banks. I think the banks are going to go higher, so I think that will help FITB. It is bouncing today. It's having a really nice day after it had moved lower with earnings yesterday. But notice with the move down, even with the heavy volume, it did not lose support. So I think it's really big that it's bouncing here. I just think it's range bound. I think there are other banks that are better. And as a result, I think on this relative chart, you can see FITB struggling now because of that gap down with earnings. I just think there are better banks out there, but I think FITB will be fine, especially with a rising group. Let's move on to the next one. I went ahead and annotated these quickly. So this should be a little, shouldn't take me too long to get through. COPX, this is the Global Copper Miners ETF. I would say I really want to see it break above the recent high and also this downtrend line. You can see the last time we broke the downtrend line and then broke that previous high, it led to a pretty nice advance. I think it might be a little premature to get in here, but if it were to break much above that 2760, 2775 area, I think that would be a bullish signal for COPX. Third up, RRC Range Resources. This one's really interesting because it is in a major gap resistance zone. Look at the heavy volume back in January on this gap down. It's now moved up. It's never filled this gap. So I think if it gets to 17, it's going to have some work to do to get through. The good news is that you've got a really strong industry group. The bad news is that RRC is one of the weakest stocks within the industry group. So if the group continues to do well, I think this one could get a little bit of a lift. It's a rising tide lifts all boats kind of a scenario. But on a relative basis, I mean, when you're looking at the chart, I think that clearly this one's had a lot of issues, and getting through 17 could become a little bit of a problem. Next up, High Point Resources, HPR. This is in the same group, but I want you to look at the difference between the chart. Here you've got a stock that's been uptrending, consolidating, breaking out. And not only is it in a good spot, in a good industry group, but it also has been rising relative to its industry group. And when you look back, it's actually, for the most part, been moving higher. So I think that's the big difference here between HPR and RRC, is that here you've got a stock that actually is performing well, just recently broke out versus the S&P 500. So of the two, I like HPR better. Next up is Amgen. I agree with Julius. I think Amgen is definitely starting to improve. There's still some overhead issues to deal with, a little bit of gap resistance, trying to break up above, say, 180. And the overall group, biotechs, I wrote about them in my blog this morning. I think it needs to get through 1975. We're sitting at 1961. Let's get a push on the biotechs, get a breakout. And then I think the relative strength that we have seen in Amgen relative to the rest of the biotechs could shine. But we got to get the group breaking out first. The sixth one is Voya Financial. Full disclosure, I own this one. I did buy it the other day when we were talking about the breakout. I like it as long as this rising 20-day moving average holds. I think it's in a very bullish ascending triangle formation. It broke out. It failed to hold the breakout, and probably a couple of years ago, that would have gotten me stopped out. But I've since learned to give them a little bit more room, and usually I'll let them go down to the 20-day moving average. In this case, we did come right back down back on Friday of last week, but we are rallying again. I think we're going to move to new highs. Here's, when you look at the life insurance group, it hasn't been great. And you go down here to life insurance relative to the S&P, ordinarily this would be a group I would avoid. But based on the correlation that we've talked about today and then also last Thursday, life insurance, in my opinion, is poised to rally. So that's one of the reasons I like Voya, because Voya relative to its peers has been uptrending. Next up is Freeport-McMoRan, FCX. I'm not a fan here. We had a double bottom, had a massive breakdown on very heavy volume. We're getting back up. We did get through 16.5, which was that was a good short-term deal. But you can see the red arrow here pointing to the 50-day moving average. I'm not sure if it rolls over here or not. Really, the past few months, this group has not been performing particularly well. So I'm going to pass on FCX. If it can get through the 50-day, through $17, get through that 50-day, and do it with some volume coming in, then maybe it's got a shot to run back to 19.5. But prior to that, I'd be a little careful. CZZ, Cosan, another one that really has been breaking down recently. I would like to have seen price support around $10 hold. We went a little bit below it. Notice the volume was much heavier below $10. Now that we're moving back up above, we're doing it on light volume. I've just got some question marks here, and you can see relative to its peers, it's been downtrending. So I'm going to I would probably just be a hold here on this one to see whether or not we can get through that 50-day. Next up is CVNA. I like this one. I think we consolidated sideways for a while here on this beautiful move up from about 24 to 30. Look at the volume pickup. Some might say, yeah, but it came back down on more volume. It did, but it didn't lose its breakout level. So it held support. It gapped up again. I think we're trading between a 24 and 30 range, and I expect eventually we're going to get a breakout here. And then the final one I had was CMCM, which is Cheetah Mobile. I think we've got to clear this trend line. So I'm not bearish, even though it has been struggling for the past few months, because gap support is holding so far. 1140 I would watch really closely. Huge gap up on massive volume back to open 2018. And then after moving up the balance of January, we've really just gone through this steady decline. And if we can get through the trend line, and especially all of these reaction highs up here around 13.5, I think that CMCM could make another run back for the 17 resistance. So that is what I have for the 10 in 10 for today. And now you've got the summary slide coming up showing you the stocks that were just covered. I did cover a bunch of them in the relative strength chart style that I use. And I believe at the bottom of the Market Watchers Live blog, I'm pretty sure that Aaron keeps a copy of one of those charts, or maybe several of those charts. But if you go in and you click on the chart, you can then scroll to the bottom and get the settings for those of you who are interested. So with that, let's wrap up that 10 in 10 and let's move on to ChartCon. Let's see. It is coming up soon, and I cannot wait for it. So let's take a look, and it is August 10th and 11th. So just a few months away, less than 3 months now. Julius, and I know it is exciting. Got a lot of great speakers, a lot of good friends of ours will be out there talking about reducing risk in uncharted waters. Very timely topic with all the volatility we had to start 2018. It's going to be interesting to see where we are by the late part of summer, because normally the market doesn't do so well once we get past the middle of July, historically. So we could be leading back into maybe some weakness then, who knows? But being able to manage risk is really important in the market, and I'm sure you would agree, Julius.
Yes, I will. I had to unmute myself because I was typing out very loud in the chat box trying to answer people. I'm listening to you. Yes, it's going to be exciting, and I'm really, really looking forward to it. Yeah, you know what, Tom? You're always talking about that closer thing, right? And yes. I'm learning about baseball. So I have this idea. You are a little league coach, right? Or coaching some baseball team.
Yeah, I've coached.
Yeah. So you probably have a like a ball and a glove and a cap.
Oh yeah.
Okay. So if you bring that to ChartCon, I will start my presentation with the glove and the ball and the cap and talk about being the closer of the conference.
Well, maybe what we do, rather than me pack it and fly with it, maybe we can find somebody out there already that has one.
Well, okay, that's it.
Well, that work, you don't need to have mine, right? You don't have to have my
personal. No, just whatever. I mean, doesn't matter. I mean, we're in the US, so it's probably readily available everywhere.
Yes, and you should start with that because you're the closer. They're putting you there.
Exactly.
I mean, this presentation you did today was awesome. So I'm sure everybody was looking forward to your presentation. But anyway, ChartCon's coming up in just a few months. Make sure you do sign up for that. I've been to a lot of conferences around the country and a lot of trading conferences. To me, there's no comparison. The amount of information, the knowledge that you're going to obtain at ChartCon does not compare to anything else. Every other conference I've been to is more of a sales presentation. That's not what this is. This is very educational, and definitely check it out. But let me go ahead and move on because we want to get through one quick market update before we get into the final segment. What would you do? Which we'll get into here in just a minute or so. But today you can see the Dow Jones. I've got this sorted. Let's sort it the other way here. You can see down at the bottom, the Dow actually lagging a little bit today. And if you go into the main members dashboard page right here, what I've done is just clicked on this market summary. So that's how you get to this area of the website. And Dow Jones lagging, NASDAQ still holding on to minor gains. If you go down Russell 2000, Russell 2000 moved just barely into negative territory. but we do continue to see outperformance and have seen that now for the past couple of months out of the small caps. That continues. The transports are back down close to that breakout level, 10,800. Be interesting to see whether that holds. If it doesn't, I would be watching that rising 20-day moving average from underneath. I think one of those is likely to hold on the transports on a pullback, in my opinion. Financials doing extremely well today, up more than 1%. We talked a lot about the banks earlier today. Banks doing very well, and you can see among the industry groups, banks are the leader currently, natural gas right behind. Semis up, Micron Technology having another very strong day today, helping the semis. Retailers definitely weak, down more than 1%, the only industry group that we see down more than 1%. The listing of the international ETFs, you can see Brazil doing very well today. Down at the other end, Australia struggling a bit on a relative basis. And with that, I'm going to move, let's go ahead and move right into the what would you do? And the question is, what would you do? And I'm thinking maybe with like a 1-year time frame. What would you do with the DJP? So let me pull up the chart first just to show everybody. This is the iPath Bloomberg Commodity Index Total Return ETN. You can see the breakout above the January high. Julius, I'm going to let you take the screen and talk about this for a couple minutes, but what would you do with DJP? Would you be a buyer? Would you be a seller? Would you just avoid it? And what are your...
I'd buy it. Can I go now?
Yes, go right ahead.
No, I mean, go. Like, as in go. I'd buy it. Go. I'm done. No, I'd buy. I'll explain to you why. No, no problem. Okay. Yes, I'm sharing my screen right now. The DGP came from me, actually, and the reason why is because it's one of the ticker symbols that I use in my asset allocation RRG. And you might be interested to see, because you cannot save RRGs like sharp charts. So we've added the pre-populated groups for individual stocks for the sectors. But if you look at an RRG, just any RRG, doesn't really matter. And the one that I'm looking at right now is the asset allocation one. And you can see that I'm pulling this one straight up. I didn't have to do anything. I didn't have to type in anything. I didn't have to change the benchmark. I just pulled it up. And that is because underneath every RRG, there is a permalink. And that's basically a URL. And if you copy that and you then save that as a bookmark for your browser, whether that's Chrome or Edge or Safari or whatever, you can come up with a sort of library with RRGs that you can pull up on the fly, and they'll be updated. So here are the ones that I had for all the individual stocks, which I used before I had the pre-populated ones. But the asset allocation one, for example, is the one that I just pulled up here. And you can fit it. And look at where DJP is headed right now. It is inside leading. It's pushing higher. And it's pretty much the only asset class right now at a strong heading, at a positive heading. So then what I'll do is I control click, and it brings up my chart of DJP. Now this relative strength line is almost flat. It's been going down forever. But what you see here, and let me make this chart a little bigger. Let's do 5. Because commodities have been in such a massive downtrend, it's unbelievable. Here you got a little bit more detail in that relative strength line. It's been going down, 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 down. It's going flat. We have some lows at the same level, slightly higher. Looks like we're bottoming out, but the RRG lines seem to be picking up some sort of underlying uptrend in relative strength, and that's very interesting. So it's going higher, it's bottoming out, but what I really, really like is the fact that we are. Let me annotate this very quickly. Seeing this breakout here, it is going higher, and that's what I like, because what I see here is that overhead resistance seems to be cleared right now, seems to be in the process of clearing it. Maybe we want to see 26, the figure, for a confirmation, but all the lows, the major lows, are higher. And given the fact that this is a super long trend, makes me pretty bullish on DGP actually. We can do this probably on a monthly scale as well, because this is I think this is a real long-term turnaround situation. And if you, there's an investment model based on the investment clock. I'm not sure if anyone is aware of that. That looks at the economic cycle, at the 4 or 5 year economic cycle, and in that model, commodities is now coming out as a preferred asset class. If we're moving to the next phase on that economic cycle, maybe I should talk about it once in a workshop or something like that. But that's a little bit more fundamental background, a little bit more quantitative fundamental analysis. And if I combine that with the big turnaround that I see on this chart, this, for me, on a long-term basis, is a very strong chart, Tom. I like it.
Okay. I'm going to take the other side of this. And I'll tell you why. Let me go ahead and bring up first the DJP. The DJP only goes back to 2006, so I wanted to show a chart first of the DJP and how it correlates to the CRB index. And so the first chart you see here is the DJP going back into 2006. I wanted to go back before 2006, and I didn't have any data for the DJP. So I want to use the CRB index for the commodities. And you can see that while it's not perfect correlation, it's a pretty strong correlation between the DJP and the CRB index. So my next chart that I pull up, I'm going to use the CRB and go from there, and just kind of use that as a substitute for the DJP. But here is your CRB going back the last 20 years. And here is the dollar. And here is the CRB relative to the S&P 500, and then a correlation between the CRB index and the dollar. Now, one of the things that drove the CRB so much higher in 2002 to 2008 was a constantly falling dollar. So 6.5 years of lower dollars helped the CRB. It especially helped gold, but it also helps, it does provide a bit of a tailwind for all commodities, but especially gold. And if you look at the relative performance of the CRB versus the S&P 500, it was mostly higher. We had a couple of periods where we pulled back during this downtrend in the dollar and uptrend in commodities. But for the most part, commodities were a great place to invest during the last bull market. This bull market, though, has been a lot different. And the big reason has been that the dollar bottomed, and that throughout this move, we've actually been seeing the dollar rise. And I'm calling for a rapidly rising dollar in 2018. I think we're already beginning to see it. I think we're going to run back on the U.S. dollar index above 100. I think we're going to challenge this 102, 103 level, possibly break through it. And currently, commodities are going up with the dollar. So I'm not saying it's impossible, but I think if the dollar does rally strongly, similar to what it did back in 2014, 2015, you can see on an absolute basis, commodities were hit very hard, and on a relative basis, commodities are hit very hard. Now, there are some different circumstances right now. For instance, the CRB, I think, is like 42% energy. The last time I looked, I mean, I could be off a little bit, but I do think energy is set up a lot better now than it was then, and I think that's why we're seeing the CRB doing as well as it is right now. But the thing that bothers me about this is that even with a real strong energy group right now, the CRB index is barely outperforming the S&P 500, and it still remains kind of in this long-term downtrend. This isn't going to go on forever, and the CRB is going to turn. I just think it might be a little premature with the dollar expected to rise, at least with me expecting the dollar to rise. It's a little premature for me to get into the CRB index. So I'm going to go with avoid for right now, but I may be willing to change my opinion later in the year, especially if the dollar makes a run and it looks like it's ready to settle down. Then I think we could be in for a really big rally.
When DGP is at 35.
There you go. Had to get that last word in, didn't you? We talked about this before the show, and this chart on DJP, I could see it getting up into the low 30s. I mean, right here was your bottom. We broke down below that. We are trying to break above this 2-year base. I completely see your point.
Yeah, I
So
agree that 30 is a level.
if it goes up, though, I'm not sure it's going to go up faster than the S&P 500, and I'm trying to beat the S&P 500. So that's why I would keep it on the avoid for now.
That's fine.
But anyway, let's go ahead and pull up the poll and take a look at see what everyone else thinks. I have a feeling they're going to agree with you, Julius. It's just one of my feelings. But we get
yes, 75%.
Oh, there we go. 75% going with Julius. 21% going with me. Okay. Yeah, I don't know if I would say I'm not a big shorter in a bull market. I still think the market goes higher. So I probably wouldn't be in that 3% category. But I do think if I'm trying to beat the S&P 500, I want strength, relative strength. And I'm not yet seeing that, not enough of it anyway. So
yeah, but the thing I think you need to be careful with it, because this is a completely different asset class. I'd be very reluctant to compare it to equities. I always compare it to a balanced index, because this could be your safe haven when equities go wrong, because it's a different asset class. So it's an asset allocation play.
Good point. Yes, I know not what you speak of with asset allocation. I have my trades and that's it. I don't.
I know. Don't worry.
I don't even know how to respond to you, Julius. But anyway, here we go. This is a summary for what would you do. It was fun. I'm avoiding. Julius would be a buyer and the audience would buy. So we'll see. Maybe we'll hold on to this slide in a year from now. We'll have you on and see what happens.
Let's definitely do that.
That would be fun. Only if I win.
Yeah, of course.
Otherwise, we're going to lose the slide.
Yep. Tempering evidence.
Yes. So, but it's been great here having you on with us the last couple of days while Aaron takes a much-deserved vacation into the mountains. And really,
it was good. It was good fun, Tom.
Yeah, I know a lot of folks from prior polls have indicated that they're not really that familiar with RRG, and I hope over the last 2 days that has changed, because I know you have provided a lot of really good information with the RRG 101. You've shown how you use it with the scans. You've shown in the 10 in 10 how you can identify stocks that look like they're starting to turn back up into a strengthening area. Great job this week, Julius. Really appreciate it.
Thank you.
All right, let's see what we got going forward here on the weekly schedule. Tomorrow, we've got David Keller joining us or rejoining us. He's been on once before. And then on Friday, everything stock charts. Not sure who we've got from stock charts this week, but I'm sure it'll be a great presentation. And as Chip Anderson always says, I'm sure you will walk away with something, or with a, what does he always say? I didn't know stock charts could do that. That's what you need to, after everything stock charts, I have a feeling you should be walking away with that mentality. But anyway, do want to wish everybody happy Memorial Day on Monday. Thanks to all of our veterans for your service, both past and present. And markets is closed on Monday, so we will not be here. So definitely we'll be back on Tuesday, though, for sure. I want to thank everybody for stopping by and joining us today. Again, thanks to Julius for filling in for Aaron. Please remember to complete the survey as you exit. We do love to get your feedback, to hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Hopefully see you back here on Wednesday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.